Imagine this, you are a millionaire who just bought a 5 million yacht. Instead of thinking about the massive expense, you realize something incredible. You can write it off your taxes. Yes, that's right. By using the yacht as a business asset, like hosting client meetings or corporate retreats, you can claim depreciation and business deductions. It's 100% legal and just one example of how the wealthy minimize their taxes. Let's explore some of the most fascinating and completely legal tax strategies that the rich use every day. But here's the key, these strategies aren't just for billionaires. Many of them, like investing for capital gains or maximizing tax free accounts, can be used by anyone with the right knowledge. Hi, guys, welcome to my channel. The first is capital gains tax rates. So, income from investments like stocks, real estates, and businesses is taxed at lower capital gains rate, for example, 0%, 15%, and 20%, compared to your normal income tax rate, which could go up to 37%. So, let's say Sarah is a tech entrepreneur who sold a company for $10 million. Instead of taking a salary, she invests the proceeds in stocks and bonds. The income she earns from these investments is taxed at a maximum of 20%, which is the capital gains tax rate, instead of up to 37%, which would have been the ordinary tax. So, this is why wealthy individuals prioritize investments over paychecks because that lowers their tax rates and more money stays in the pocket. The second is something called step up basis. When someone inherits assets, the asset's value is stepped up to its market value at the time of the owner's death. So, this reduces or eliminates capital gains taxes on the appreciation of the asset during the original owner's lifetime. Let's say this guy John who bought a 1 million beachfront property in 1980 and by 2024 it's worth 5 million. Now John would owe taxes. If he sells it, he would owe capital gains tax on 4 million, but when John passes away, his daughter inherits the property and the value is stepped up to 5 million. Now she sells it immediately but does not owe any capital tax. Now, the step up in basis allows wealth to pass tax free, and it's a powerful generational wealth tool. The third is called real estate depreciation provision. So, real estate investors can claim depreciation deductions on their properties even if the property's value is appreciating. Now, these deductions reduce their total taxable income. So, let's say someone owns a rental property that generates 100,000 in annual rental income. Thanks to the depreciation deductions, he reduces his taxable income by $20,000 and pays taxes on only 80,000. So these deductions would still apply even if the property values increase. The fourth is called 1031 exchange provision. So real estate investors can defer capital gain taxes by using the proceeds from the sale of one property to buy another like-kinded property. Now, Mary owns a rental property worth $500,000. She sells it and reinvests the money into a new $700,000 property using something called 1031 exchange. This way, she avoids paying capital gain taxes on the $200,000 profit from the sale. So, the takeaway is that by continuously swapping real estate properties, these investors defer taxes indefinitely and then they can pass it to their heirs. The next provision is something called carried interest. So, the hedge fund managers and private equity partners earn much of their compensation as carried interest, which is taxed as a capital gain instead of ordinary income. So, this loophole lets fund managers save millions in taxes every year, which obviously sparks debate about the fairness. The next one is about foundation and charitable contributions. So, setting up private foundations allows the wealthy individuals to donate assets, receive an immediate tax deduction, and maintain control over how the funds are distributed. They can also donate appreciated asset to charities, and this avoids capital gain taxes. So, Jane, a billionaire, donates $50 million worth of stock to her private foundation. She gets a massive tax deduction, avoids paying capital gains taxes on the stock's appreciation, and still controls how the foundation spends the money. So, philanthropy isn't just about giving back, it's a strategic way to reduce taxes while maintaining influence. And there's something called a life insurance loan taxation. Life insurance isn't just a protection, it's a hidden bank account for the wealthy. So, wealthy individuals use permanent life insurance policies to build tax free cash value. They can borrow against these policies without paying taxes. The next strategy is something called tax loss harvesting. So, wealthy investors sell losing investments to offset taxable gains from the winners. They can then reinvest in similar assets to maintain their portfolio's value. The next is the Roth IRA conversions and backdoor Roth IRAs. High earners can bypass income limits on Roth IRAs by contributing to a traditional IRA and converting it to a Roth. Roth IRAs grow tax free and allow tax free withdrawals in retirement. The last one is pass through entities. Business owners structure their businesses as S corporations or LLC or other pass through entities to benefit from the qualified business income deduction or lower tax rates on business income. These strategies are legal and often encouraged by the tax code to promote investment, entrepreneurship, and philanthropy. But they are sometimes criticized for, disproportionately benefiting the wealthy. What are your views on it? Let me know in the comments. I'm not a tax expert, and this video is for general informational purposes, but make sure to educate yourself financially so that you know that these provisions exist and how to make best use of these even on your modest income. My name is Parul. I'm an economist, and follow me for more financial tips. Please don't forget to hit the like button and subscribe to my channel. Take care. Bye.